Good afternoon, everyone. My name's Ed Morse. I'm chair of the New York Energy Forum, which together with the Center on Global Energy Policy at Columbia is really pleased to sponsor this event. We do a number of joint events over the course of the year. This one, unlike many New York Energy Forum events, is at a university. It's therefore entirely on the record. And if there's anyone from the world of the media who's watching in on a live cast or here present, it is very much an on-the-record occasion. We're extremely pleased to have this discussion today. Programmatically, the discussion is going to begin now. It's going to go on for an hour and a half, or no longer than an hour and a half, depending on the discussion. There'll be a couple of presentations, and then afterwards, at 7:30, we'll have a reception at the other end of this corridor. We're very pleased to have today's discussion on oil field innovation in an environment of falling oil prices. And yes, we're meant to think about oil field innovation that's global, but more pressing, of course, is the biggest unknown confronting the oil market right now, and that is what is likely to be the response of the shale plays in the United States and elsewhere in the world as prices rise, and there will or will not be a robust drilling response to that increase in prices, maybe even a more robust one that than many people calculate on there being, given the fact that we all know that there was wanton spending in the shale plays in the United States in 2011, 12, 13, and 14, and we don't know whether the financial markets and the energy markets will be more disciplined this time around when oil prices go up than they were before. We have two really remarkable speakers. Robert Kleinberg is with Schlumberger. He's been with Schlumberger since 1980. He is a Schlumberger Fellow, which I think gives him a rank of being a maverick in many ways. He is in the workforce of over 100,000 people, and he is very much tied to the frontiers of research in unconventional oil and gas at Schlumberger. We also have Bobby Tudor, who will follow Robert Kleinberg in a formal presentation, after which we will open this to discussion. Bobby is chair and CEO of Tudor Pickering. He had previously been a partner at Goldman. He's extremely well known for his outspoken, clever views on the market, and he certainly understands the investment side of this business as well as anyone that I've ever met. So with no further ado, we'll start with Robert's presentation. It will be 15 or 20 minutes, after which we'll go to Bobby's, and then we'll open it up for discussion at the front and open it up to you. Thanks very much.
Well, thank you very much, Ed. It is a real pleasure to be here at this joint event of the New York Energy Forum and the Center for Global Energy Policy. I'm based up in Cambridge, Massachusetts. I discovered today that indeed taking the train is easier than driving, but certainly glad to be here. And I'm sort of the lead-off speaker. We're going to talk about oil field innovation, and as you might expect, since I come from Schlumberger, I'm sort of the technical anchor of this conversation. I'm going to be talking about sort of the technology aspects of innovation. There's also business innovation, of course. I'm not going to talk about that. So let's see. Get started. I think all of you are probably familiar with Schlumberger, at least in a passing way. We are the actual provider of exploration, drilling, and production services to the oil and gas industry. In other words, we are the guys that do the work. On the left is a picture of me in front of a oil drilling rig that Schlumberger does not own, but we did all the downhole assemblies and so on for it in the Eagle Ford play in Texas. On the lower right is a photograph I took in Greene County, Pennsylvania, in southwest Pennsylvania in the Marcellus, and that's all Schlumberger equipment and personnel, fluids, and so on. So we're the guys that actually do the work. So there's certainly a lot of talk about innovation these days, and so this is a very sort of representative statement that one sees quite frequently. U.S. shale resilience, a product of innovation, CEOs say. This is from the Oil and Gas Journal. You see very similar comments in a range of investor presentations, trade publications, analyst reports, and so on. Basically, the story is, don't worry about it. Innovation is going to pull us out of this mess that we're in with these very low oil prices. And I read that, and I'm sitting in the research lab of Schlumberger, which I hope I can say without exaggeration is a center of oil field innovation. And I'm looking around, and I know what our time scales are for innovation. And I'm thinking, okay, what do they actually mean by innovation? And so I wanted to look at this question a little bit more carefully rather than just accept this sort of bald statement that innovation is going to solve the problem. So there's a lot of things go on in the course of a business cycle and in the course of developing a field. And the first thing that happens, and probably the most important thing, are a series of process and efficiency improvements. And what I've done on this slide is I've sort of made lists of sort of things that increase costs and things that decrease costs. And it turns out that things that increase costs mostly come early in the development cycle, and that's sort of the yellow shading. Things that decrease costs are mostly late in the development cycle. So let me give you a couple of quick examples. So in the sort of drilling, completion, and stimulation, basically early in the development cycle, the drillers are unfamiliar with the geology. The people doing the hydraulic fracturing are unfamiliar with the mechanical properties of the rock. And there's a lot of surprises. That's a euphemism for kind of screw-ups. Later on, after the drillers and frackers and so on have gotten experience, they become much more efficient. And so you see late in the development cycle, costs going down very quickly, number of days to drill a well decreasing very substantially. Early in the development cycle, you see competition for leases. So at first, leases are cheap before people understand the potentiality of a play or a field. They get bid up. People come in late and overbid. We're all familiar with that phenomenon. Later on, lease costs decrease in a sense because leases get consolidated, traded, and that improves efficiency. There's supply chain bottlenecks early. Those supply chains are optimized late. Infrastructure bottlenecks early. Infrastructure gets built out and becomes less of an issue late. And then on the service company side, we come in, we've got equipment shortages and personnel shortages. You're waiting on Schlumberger, and you're going to pay more to get to the top of the waiting list. Later on, we've got more equipment. Our competition has maybe unfortunately moved in, and prices go down. So that's the overall process and efficiency improvements that you always see. And this was illustrated really very well in a recent report that came out of the Energy Information Administration. On the left is a plot. Horizontal axis is in years from 2006 to 2015. Vertical axis is well cost in millions of dollars in a variety of U.S. shale gas and tight oil plays, illustrated by the map on the right. And they all sort of track each other pretty closely. Early in the cycle of developing these resources, you see cost increases of 40 to 50%. And what EIA has done here is that they've indexed their costs to a standardized well design. So we're comparing apples to apples here. That peaked out about 2012. And since 2012, well costs have come down a lot. They've come down 25 to 30%. And the thing that I want to emphasize here is that costs started decreasing in 2012 when oil was still at 100 and continued down even while oil maintained at 100. And then when the price of oil fell, well costs continue to fall. And in fact, a little bit faster, not shown here, but 2016, the prices will be lower. So what I'm trying to say is that there's a lot of things that go on that you could call innovation that occur no matter where you are in the business cycle. It's just people learning to do their job better. Now, there are what I call downturn-driven efficiencies. And this is mostly in the realm of what you might call asset high grading. And there's several different kinds of asset high grading that are going on simultaneously. And these things are things that happen once the price of oil has fallen, dramatically, as we saw mid-2014 to early 2016. For one thing, no more exploratory drilling. You're gone. You've reduced your rigs by 75%. There's no rigs that are going into the Tuscaloosa Marine Shale or whatever you've got and trying to find new plays. That's all done. What you see instead is what I call ultra sweet spotting, which is you take your best resources that you found, that you've already de-risked, and focus on them with a laser sharp focus beam. And so you're really high grading your drilling program. You're also completing those drilled but uncompleted wells, the so-called DUCs. The inventory built up during the boom times when Schlumberger couldn't get out to you fast enough. And now that inventory is now being worked off. And then finally, when you've reduced your rig count by 75% in North America, guess what? The 25% that survive are the very best, most up-to-date modern rigs and the very best, most efficient crews. So that's another form of high grading. And so I put all these under the rubric of intelligent downsizing, and certainly the industry has downsized and has done it in this intelligent way. Now there's also technical innovations, and these are innovations, but they are really independent of the business cycle. Things like pad drilling. So I think we're mostly familiar with that. Basically, you're drilling lots and lots of wells from a single 5-acre site. So you have enormous efficiencies in site construction and in well construction. Instead of taking apart your rig and moving it to another part of the landscape every time you want to drill a new well, the rig creeps on sort of tank treads from one wellhead to another. That's a big improvement, and that's one reason why our rig counts and our well counts are starting to diverge in sort of ahistoric ways. And then with a bunch of wells, which could range from 4 to 12 on one little 5-acre site, you've got a lot of supply chain simplification. And I like to say that in the days of conventional oil and gas, the 150 years of conventional oil and gas, the exploration geophysicists were the gods. Now the supply chain managers are gods. So simplifying supply chain is a really big deal. So really what pad drilling has done is that it is finally the realization of the long sought for factory mode of drilling. People have been talking about factory drilling for years, and now we are really doing it in the sense that we've got a little site, we bring in our frac trucks, they sit there for 4 or 6 weeks, fracking well after well after well without moving, huge improvement in efficiency. Finally, there's the super fracs, longer laterals, tighter fracture initiation points, a lot more water per linear foot, a lot more sand per linear foot. This is what I call even more brute force. It's not rocket science, but it's innovative in the sense that people did practical experiments to see how they could boost their initial production, and that's really the name of the game because that's what can be easily measured: the initial production, the highest 1 month production. Now, these technical innovations again really had nothing to do with the business cycle and with resilience in the face of falling oil prices because they were going on all along, and they continue. So what about big innovations? I mean, we've talked about sort of small innovations and medium-sized innovations. What about industry-changing innovations? That's what I'm personally in the business of, so I'm interested in it. What I've done, I obviously don't have time in these few minutes to present them all, but I've done a series of case studies on industry-changing innovation and how that changes through business cycles. So I've looked at 3D seismic, I've looked at logging while drilling and geosteering, I've looked at rotary steerable drilling, and finally horizontal drilling and massive hydraulic fracturing for shale. And without giving all the details of these studies, I can give you some preliminary conclusions. So, firstly, when oil prices are rising or high, there's certain things that are pretty familiar that we all know happens. Industry R&D is going to be growing. It's going to grow with revenue. Research prioritizes novel techniques, and new people are brought in, frequently with no background in the oil industry. You rarely hire a petroleum engineer in a research lab. But these people come in, they generate fresh ideas, some crazy, some work out, and are important. Academic and government research also sort of gets thrown into the mix. The national labs become active, government-funded research that goes mostly to universities. And this sort of research tends to be driven by perceived societal goals. In the 1970s, those goals centered around petroleum and synthetic fuels. In the 1980s, unconventional gas, which was tight gas, coal bed methane, and yes, shale, were the big subjects of research interest in national labs and in academic labs. And then in the 2010s, fossil fuels have sort of gone out of style in that community, and most of the emphasis has been on renewables. Now, what happens during the down part of the cycle when oil and gas prices are falling or low? Well, academic and government oil and gas research wind down. So there's sort of less excitement, the students are less excited, government's less excited. So those things wind down slowly. Industry R&D shrinks sometimes pretty fast. Hiring definitely cut. Layoffs we've seen, although not as much as the organization as a whole. There's less emphasis on novel techniques and more emphasis on efficiency improvements. So you tend to shorten the time span of your projects, and because you're losing people out of your organization, innovations get lost. That's just how it is. Another interesting thing that happens during down cycles, and we've seen this several times now, is what I call downsizing of risk. And what happens is that our technology development gets outsourced. So back in the 70s, the main innovators were the international oil companies, your Shells and Exxons and Chevrons and so on. And in the big mid-'80s collapse, a lot of the IOC R&D and innovative research got outsourced to the service companies, to the Schlumbergers and the Halliburtons. What we're seeing in this cycle is an acceleration of something that had started a few years before, which is the service companies looking more toward the startups as a source of ideas and innovation. And certainly Schlumberger has a substantial and active mergers and acquisitions group that sort of scoops up little companies that seem to have good ideas. Now, that said, you have to ask, and a very important question to ask is, who are the technology leaders going to be in the next upcycle? And certainly if you look at history, the answer is pretty clear. The technology leaders of the next upcycle are the ones that shrink the least in the down cycles. And the reason is that these industry-changing innovations take 10 or even 20 years to develop. So you really need patience to carry through. Your staff is going to be smaller, but the survivors, the true believers, will carry on through thick and thin. And what we often see is that the great, brilliant ideas that are developed during the upcycle actually get engineered and deployed in the midst of the down cycle. And maybe financially that's not so good for us, but that's the way life is. The innovation cycle is longer than the business cycle. So that sort of concludes my part of the remarks, and I'll be happy to talk about this later during the open discussion.
Thanks very much for summarizing what's been going on. You are going to get, I'm sure, a whole bunch of questions on what does it mean for production levels and other things going forward. And with that, we'll turn to Bobby. Thanks.
Okay. Thank you for having me very much, Ed, and it's always a pleasure for me to be at Columbia and in New York talking about the oil and gas business. So I'm going to talk mostly, as investment bankers are prone to do, about money and how the technological changes that we've seen over the course of the past several years has translated into a fairly dramatically different landscape for the industry, particularly here in America, but with broader sort of worldwide implications. And here are the key takeaways. As a result of lower oil prices, U.S. oil and gas producers have dramatically reduced their cost, but at the same time, and this is due to technology, have actually increased reserves and productions through these multiple technological improvements. The great laboratory for all of this has been primarily the Permian Basin of West Texas. Those of you who follow the industry know roughly where that is. You kind of go to Midland, Texas and draw a big circle, and right there, about 2/3 of the rigs working in the U.S. today are working within about 100 miles of Midland, Texas. It's been just an incredible laboratory over the course of the past several years for fairly dramatic improvements in the industry and in technology. What's happened in this laboratory is that completion designs, the way wells are completed, have been highly optimized. And what that means is they have dramatically increased proppant levels, dramatically lengthened lateral drilling, and dramatically increase their fluid volumes, all resulting in much higher estimated ultimate recoveries of the wells. The value, if you will, of any one given well, because of the associated estimated ultimate recovery of that well, has gone up. And despite the fact that there are incremental costs associated with this well design optimization, you've had simultaneously fairly dramatically decreased drilling and completion cost and other drilling costs on the order of kind of 25% all in. So you kind of roll all that together, and what you have is U.S. oil supply broadly defined declining, with very large base declines in the Eagle Ford and the Bakken, but U.S. supply in the Permian Basin actually flat to slightly up, even during this period of dramatically lower oil prices. And I'm gonna get to how the industry has sort of pulled that off. Currently, global projects, outside of the U.S. need oil prices on the order of $45 to $45 WTI to break even. Now, there's a lot of variation in that, and I'll show you a slide in a moment that points to that, but that's a number to remember when people ask, well, what does the industry need to sort of survive globally? Our view is that it can survive at $45, but it can't grow at $45, and then that leads to a broader conversation around, well, what is going to be demand worldwide for this stuff? Is it going to grow over the course of the next decade or not? And if it is going to grow, as we think it will grow, at least for a while, where is the supply going to come from to meet that? And what sort of price do we need for that to happen? I'm going to talk about what happens when prices start going up again, because we've been in this period of oil prices going from $100 to $29 and now back to $45 WTI, and so we have seen costs drop dramatically. But the big question for the industry, for Schlumberger and for their customers like Saudi Aramco, is how much of those costs stick? What happens to costs when we start seeing upward pressure on commodity prices? How much of the savings are structural and how much of them are purely cyclical? And I'm going to talk a little bit about both of those things. So this is kind of just a helpful sort of level set here. These are the world's largest oil fields. On the left and on the right is the largest U.S. Oil fields, and it's actually a pretty dramatic slide, because we're reaching a point quite quickly where the Sprayberry and Wolfcamp trend, which is an important piece of the Permian Basin in West Texas, is not all that different from Guar. in Saudi Arabia. And a lot of people feel like if you look at the Permian Basin in the aggregate and you include the Delaware and you can include a bunch of the new benches in the Permian, we're actually going to have a U.S. oil field which is bigger than Guar. So we would never have said that 5 years ago or 10 years ago or certainly 20 years ago. It just didn't seem conceivable that we would have those sorts of reserves onshore in the United States. On the right-hand side is you see where that matches up against sort of the rest of the largest oil deposits in the U.S. The Eagle Ford Shale in South Texas being second, Prudhoe Bay in Alaska third, the Bakken Shale in the Dakotas fourth, the Delaware Basin also part of the Permian fifth, et cetera, et cetera. So really the point here is that the Permian Basin has turned out to be just a massive, massive thing. It's really changed the face of the American industry and highly impactful on truly a global basis. You heard Robert say that companies no longer really drill for oil. That's true. At least in the United States, they don't drill for oil all that much. And the reason they don't is they know it's already there. So they don't drill to discover, they drill to produce. And that's a big part of the reason there's been this massive sucking sound around capital from the rest of the world to the United States. If you're doing exploratory drilling in West Africa or East Africa or Kurdistan or the Arctic or you name it, with that comes very substantial exploration risk. You can spend not just tens of millions of dollars, but literally billions of dollars preparing for true exploratory wells with some substantial risk that you will find zero, and that $1 billion will have absolutely no return. In the shale business in the United States, you know that the oil is there. It is absolutely there. And the only question is, can you produce it economically? Can you get your cost structure to a level that this stuff will come out of the ground at a financial return that makes it acceptable for you to drill? So all of that has resulted in a fairly kind of dramatically different landscape for energy companies broadly. This is a very important slide for if I was going to just kind of remember 2 or 3 slides from this presentation, this is one that I would focus you on. So what we've done here is we take all of the major producing areas in the United States, and we chart the break-even price required. And when we say break-even price required, what we mean is what oil price do you need to generate a 10% IRR at the wellhead level on an average well in the play. And so it's charted by year. The blue is 2016, the green is 2015, and the yellow is 2014. And what you can see is that over this period of time, the break-even prices required in these fields have decreased, and they've decreased very dramatically. In a moment, we'll talk about why. And so if you go to the bottom of the slide, you'll see that relative to 2014, the break-even price for Bakken Tier 1, really good stuff in the North Dakotas, is down about 40%, and the current break-even is $28. And we have that all the way across really for every part of the U.S. business. And if you focus on the green on the bottom, what you can see there is the current break-even prices required to generate a decent IRR on a U.S. well is, call it, somewhere between $30 and $45, roughly speaking. WTI prices today are at $46. So generally speaking, the U.S. business has adjusted its cost structure with the help of fairly dramatic technological improvements to a level at which actually you can generate a decent rate of return at current oil prices. Now, that's not the whole story, because you may generate decent rate of return at those oil prices, but you might not be generating enough cash flow to drill enough to actually keep your production flat, which is a slightly different issue related to capital availability and capital markets and all sorts of things. But if you kind of remember all the chatter around the dramatic drop in oil prices, the nature of that chatter was, well, this is going to drive the high-priced U.S. production out of the market. And what's happened is that it actually has driven high-priced production out of the market, but not all of that is in the U.S. And in fact, what's happened is the U.S. has become moderately priced production. It's no longer the high-priced production in the context of the global oil and gas business. In some cases, it's actually relatively low-cost production, as you saw from that earlier slide. These are global supply projects. So outside of the U.S., the things that people like Total and Shell and ExxonMobil and Eni and international oil companies of all sorts have historically run around the world and spent billions of dollars doing. And so it's offshore Angola, it's deepwater Gulf of Mexico, it's the Lula field offshore Brazil. These are the great sort of projects and finds outside of the U.S., outside of the shale business over the course of the past, five years or so. And there are a few things to remember about this slide. One is look where it says first production. So Shenandoah was actually discovered, when was Shenandoah discovered, Ed? Do you remember 08 maybe or something like that? 07 or 08. So this is a major oil field in the Gulf of Mexico. It will be 12 years from the time that discovery well happened till when first production comes online. 12 years and billions and billions and billions of dollars to make that happen. Now, at $53 full cycle, that becomes an economic project for the owners of that. And so if you're ExxonMobil, if you're Shell, if you're a major oil company, you look at that and you say, wow, that took me 12 years. I risked multi-billion dollars. It could have been a zero, and I need $53 at least for this to break even. And if I'm going to generate any sort of real return, I need $60 or $70 over time. And I compare that to the Sprayberry Wolf Camp in North America, where from the time I decide I want to either acquire property or acquire a lease to when I can actually be drilling my well, it could be 4 months, 6 months, nothing like 12 years. By the way, when I start working it, there is no chance that it's a dry hole. There will clearly be oil there. And my cost structure is now at a place where I can generate very attractive rates of return at lower break-even oil prices. That slide before showed that in the Midland Sprayberry Wolf Camp, I need $30 or $28. This tells me for Shenandoah, with a lot more risk, I need $53. So if that's the case, where should I put my capital, right? And that's why all the capital has come out of the deepwater business, out of the international exploration business, and focused more and more and more on unconventional oily resource onshore U.S., Canada, and other places in the world too. It's not just in the U.S. and Canada that this unconventional resource exists. So let's talk about what improvements in well costs and EURs have really done. On the top is well cost, once again charted by year. And what you see is that by area, those well costs would be down somewhere between 15 and 50%. And on the bottom is the estimated ultimate recovery of the wells. And what you see there is they are up somewhere between, call it 5% and 60%. So you put those two things together, dramatically lower well cost, dramatically higher estimated ultimate recoveries, and guess what? I no longer need $60 or $70 or $80 to earn a decent return on my capital. At $35 or $40 or $45, it actually works just fine. And that's why the business is kind of getting back on its feet in the United States. A little more about the Permian. At the top here, you see kind of year-to-date production, what's happened over the course of this year. And so we have had slightly strengthening oil prices over the course of the year. If you remember, we started very low in the 30s. We had a bit of a run-up. There was fear that was a head fake. We traded back down into the high 30s and now have stabilized kind of in the mid to high 40s. But because of these technological innovations, we've got production that actually has gone up over the course of the year in the Permian. And this is our kind of forecasted production going out further for the Permian Basin. And so you can see that we are projecting still fairly dramatically increasing production in the Permian Basin. These are the things that has driven it. So by year, these are the fluid volume changes where we've gone from a range of 20 to 30 barrels per foot to 40 to 60. These are the lateral length progressions of kind of 3,700 feet up to call it 7,000 to 10,000. And just pause on that for a moment, because that is a remarkable thing. Remember, what you're doing is you're going miles underground and miles sideways. Technologically, it's really quite an amazing feat that you can do that and land it very often in exactly the right place in a zone about that big. It's really a credit to Schlumberger and the industry that we're able to do that. And this is proppant loading shifts. For those of you who follow the industry closely, you know that a lot of the controversy around the unconventional business in the U.S. has to do with the heavy amounts of proppant and water required to complete these unconventional wells in North America. And part of the reason they keep getting better and better is we keep using more proppant, longer wells, more fluid, more water, et cetera. So it's having fantastic effect on the estimated ultimate recoveries of the wells, but it's also a big user of resources, in particular water. And if I had to point to one major challenge for the industry right now, it's to make progress on recycled water so that you're not using as much fresh water with these massive loads. This is the Williston Basin. The Williston Basin is otherwise known as the Bakken, and we've had some of the same sort of technological success in the Bakken. Here at the bottom, you see what's happened to proppant loading. At the top is what's happened to EUR. So the more proppant we've loaded, the better EURs we've had, the better well results we've had, the lower break-even costs we've had. Just another example of how the industry has sort of reset itself. Now, all that being said, outside of the Permian Basin, base decline rates in the U.S. have actually been quite steep. And this is sort of the dirty secret of the unconventional business in the U.S. Base decline rates, meaning what happens to a well once it comes on, is the shape of the curve like that over time, or is it like that over time? And in many of our unconventional reservoirs, base declines are very, very steep. And so one of the things that the industry is working on is trying to arrest those base declines and make the curve flatter. But they continue to be very steep. And that's why in most parts of the U.S., as we've had this dramatic drop in the rig count, and thus dramatically fewer wells being completed, we've seen a pretty actually rapid fall off in U.S. production. And so you read some of the paper that says U.S. production has been stubbornly high, stubbornly high, stubbornly high. We wouldn't call it that, actually, when you look at these slides and see what happens to base decline in places like the Eagle Ford and the Williston Basin. That does lead, though, to the question of, wow, so if U.S. outside of the Permian is declining and worldwide demand growth continues to grow up, who's going to meet that supply need? And our view is there's really only two places in the world that have the ability to grow their supply at these at prices kind of in and around $50 WTI. Once that assumes Iran and Iraq are kind of back to their full capacity levels, and it's basically either Saudi Arabia or the U.S., and that's it. We don't think Mexico can do it, or Venezuela can do it, or almost anywhere else in the world, really. And that's a lot of the reason we have confidence that the market is actually rebalancing, and we're going to see higher oil and gas prices over the course of the next 2 years, meaningfully higher oil and gas prices than we see right now. This is just another measure of drilling improvements. This is days to total depth. And what this tells you, for example, let's pick a color, the green color, which is Delaware, the one on the top. In the second quarter of 14, to get to total depth drilling a well in the Delaware Basin, you needed 29 to 30 days, and today you need 22. Well, that is a big difference in your well cost, and it's really happened in every single part of the business. And so just another example of how improved technology has really driven down the break-even cost of the business. So if you think about all that improved technology, it's worth drilling down a bit on the various kind of pieces of the services business, your drilling and completion costs, for example. And this shows you what has happened to pricing and the various components of that. And so whether it's directional services or mud and chemicals or pressure pumping or your casing, you name it, all of these things are down, call it 25% to 60% over time. Your lease operating expense, which is labor, basically, and other LOE, is similarly down 25 to 75%. Now, the result of all this is that the services industry has just been decimated. It really, and with the exception of the really big, strong players like Schlumberger and Halliburton, the services industry not just in the U.S. but globally, but particularly in the U.S., has really been decimated. So the question, as I said earlier, is okay, on the way back up, if TPH is right and we've got a rebalancing market and there's going to be upward pressure on oil prices, what's going to happen to those costs? How much of those cost improvements stick, and how much of them do you give back on the way back up, thus driving back up that break-even price that I keep talking about? Our view is that even with a dramatically increased rig count, so current rig count in the 425 or 450 range, that doubles to 800 or goes to 1,000 or goes to 1,200, what happens to your cost? Our view is that there is so much excess capacity in drilling rigs in the U.S., and there's so much continuous technological improvement that most of the costs that producers are now getting on the drilling side will stick. And then, in fact, you're going to see very little cost appreciation in drilling. On the other hand, completions are a different story. So that's pressure pumping and all the things associated with completing a well. We think a good chunk of that you're going to give back as the market tightens and moves back up. So you see here that our projection is that once we get back to 1,200 rigs in the U.S., and the reason we use 1,200 rigs in the U.S. is we think that's the number of rigs that ultimately will be required to keep production flat in the United States, given the base declines in these other fields. If you need 1,200 rigs to keep production flat, what's the cost associated with that? And we're suggesting, as though we're unlikely to get all-in cost all the way back to the height that they were in 2014, they are going to go up pretty substantially over current costs. So we think, 50+% of the cost savings we're going to lose on the way back up, and life is going to be a lot better for the services companies. But the corollary to that is that then will drive that break-even price back up again. So we got it all the way down here until into the 30s and 40s for much of the U.S. business. That's going to creep back up over time. So we feel like if you need 1,200 rigs to keep production flat in the United States, and costs are going to creep back up as you move back to 1,200 rigs, then what does that imply for oil price? And what it implies for oil price in our mind is that you're going to need a price well above $60. We're arguing something closer to $80 WTI to have a sustainable business that can meet worldwide demand. This is just another graph of pressure pumping CapEx, and what this tells you is that the pressure pumpers have been growing their fleets, but their CapEx actually has been shrinking. And what that tells you is that ultimately you got to pay the piper, and you have to put CapEx into your fleet. And when that happens, pricing starts to get pressured back up. So this supports, in our view, the earlier slide that indicated we think people are going to give up a lot of the savings that they've gotten in the last couple of years when the market strengthens again. And this is finally just a commentary on overall supply demand worldwide. And what these charts, so these are basically inventories. So we're pretty confident that we have our handle around what's going on the supply side. The demand side is a little trickier because some big chunk of worldwide demand growth is from Asia, and some big chunk from that is from China, and it's really hard to be clear around what's happening to demand growth in China. But inventories tend to tell you a lot, and we've clearly had excess inventories in global oil markets over the course of the past couple of years. But these charts tell you that they actually are tightening, and so the normal band of inventories here in the middle, we still have. The 2016 inventories are way above the normal, obviously, but 2017 inventories would indicate that we're actually going to have a dramatically tightened market in 2017. Our biggest worry, actually, at this point, is that that tightening market is going to result in fairly volatile upward spikes in the oil price in 2017 and 2018 in a way that will be disruptive to global markets again, and actually not very helpful to the industry. We are pretty clear, though, that we cannot grow global production at prices in and around where we are today. It just can't happen. And companies can't generate a good enough rate of return on their capital. And so therefore the market has to rebalance, and the question is how long does that take? So the industry has responded very aggressively to these low oil prices and has responded effectively, and we'll see how it plays out over the course of the next year or two. Thank you.
Thanks very much, everyone, and thanks for your patience. Those were wonderful presentations. I'm going to start off with a couple of questions to our speakers, and then we will open it up. When we open it up, I hope you can, even if you know me intimately, identify yourself for those of you who don't know you, and ask your questions. So first, Robert, I'd like to ask you whether you certainly generally concur, because you had an inflationary impact coming ahead, whether you generally agree with what I guess you could translate from where prices are, where costs have been and where they're going. They're down a bit. They'll be up maybe half that rate. That's sort of maybe 40% inflation going forward from where we are into stability. Do you concur with that, and could you broaden it to other areas of unconventional, to the degree you feel comfortable maybe talking about deep water or oil sands as well?
Well, I'm not really an expert in costs, but I will say I generally agree with what the points that Bobby made. One thing that's sort of interesting with respect to costs is what has happened to the pressure pumping capacity during the downturn. What I don't know, and maybe you have more visibility on it, is how much of our pressure pumping capacity was basically written off versus stacked. You know, when equipment is stacked, it gets put in the warehouse, and certainly what Schlumberger has done is that it's been very careful to store unused equipment in a way that it can be brought back fairly quickly. However, maybe some of the smaller players who cannibalized part of our market during the upcycle, maybe they were not so wise in how they disposed of their assets. One factor is that during an upturn, the industry tends to be somewhat less efficient because you're bringing in new people. You can't count on just rehiring the same 50,000 people that you just fired. So oftentimes during upswings, we find sort of decreased operational efficiency. So these are all things that sort of come in and you have to consider, but I'd be reluctant to give you any numbers attached to those factors.
I would agree with that. Generally, you know, per our work, we think there is dramatic underinvestment that's happening in the sector, right? In certain parts of the sector right now, pressure pumping would be a good example. A lot of that equipment will leave the market via attrition or lack of kind of capital attention, if you will. And when that happens, all the leverage goes back ultimately to the service provider because there's not enough equipment. And if you're a producer and all of a sudden oil prices are $70 again and you really want to ramp it up, well, guess what? You're going to be willing to pay higher prices for capital, so for equipment. And that's very much just been the history of the business. It really is kind of boom and bust, and leverage tends to shift very dramatically from the producers to the services companies, depending on what part of the cycle that you're in.
I'd like to turn to something that was tantalizing in your presentation, Bobby, that you didn't either chose not to talk about or forgot to talk about. And you had in your list of projects Norwegian Arctic Deepwater Project with the startling break-even price of $30 a barrel on a project that is likely, or has been announced, to be able to produce at peak 660,000 barrels a day. Is that an anomaly?
Well, certainly if you look, you're referring to the Sverdrup
Yeah.
project, presumably, that Statoil is discovered and operates. If you look at the last 5 to 10 years, you'd have to say it is an anomaly, because there has been very little of size found industry-wide in oil in the last 5 to 10 years. Not true in natural gas. There have been some very, very large natural gas discoveries in the Mediterranean, in offshore Israel, Egypt, and other places. But in oil, it's actually very much an anomaly. The returns on capital in exploration budgets globally have been absolutely awful. And so what's happening is the big oil companies accustomed to exploring internationally have slashed their capital budgets. Now, that's in part because their balance sheets are generally stretched associated with lower oil prices, but it's also because they're just not having any success. And at some point, their investors, to the degree those companies are public markets, get unhappy with dry hole after dry hole after dry hole. So it's just gotten very tough to find oil in new places worldwide. And that as I mentioned, has clearly contributed to capital flowing out of those projects and into the onshore North American business.
Yeah, I'd like to test you on that a bit, only because I was in, I spent some time in your business. I spent time in an oil company and got to observe people's motivations and their behavior. We have not seen the cost deflation in deep water that we've seen onshore U.S. That may be an optical illusion. It may be because unlike the onshore, where we've had a very competitive, responsive services sector, if you have a sixth-generation floater that you're leasing to a company on a 3 or 4 or 5 year contract at $600,000 a day, you're maybe unwilling to start off at $200,000 a day.
Right.
But
Right.
Clearly that 20% of the cost structure is going to see some cost deflation when companies decide to go
mostly they
back.
just haven't rolled off the contracts yet. And you're absolutely right. The other issue is that the equipment required in deep water exploration is just more specialized and there are fewer providers. And so at the end of the day, there's just less competition is the truth of the matter for subsea trees or you name it. Now, I'm sure Cameron would take issue with that. They would say there's plenty of competition for that. But this is highly specialized, highly engineered equipment that's quite different from onshore stuff.
Yeah, it has been interesting that the subsea market has been consolidating. Of course, Schlumberger bought Cameron, and I guess FMC and
Technique.
Technip have joined together. So there has been some consolidation, which will probably improve their markets. Yeah.
We're wide open for questions if anyone wants to start. Yes. Wait for a mic to come to you, maybe?
I don't need a mic, it's all right.
I know, but somebody else needs a mic because it's being live streamed. Can you go up to the podium, please? And identify yourself, please.
Vinay Pandey from UBS Private Wealth. A question about the debt. You didn't mention debt, Bobby. They have incurred an enormous amount of debt. What sort of a challenge is the debt servicing, and how will this be worked out? And quite apart from future capital coming in, are workouts and future workouts part of the equation too?
Right. Well, debt loads have been a big challenge for the industry because the industry did go into this downturn with too much debt. That's almost always the case in a downturn. The industry has too much debt. What's interesting about it this time around, however, is that the depth of the cyclical downturn put the major oil companies under real pressure to maintain their dividend. And that's quite an important thing if you were BP, if you were Shell or ExxonMobil. Some very large percentage of your shareholders buy your stock because of your dividend. So they've been under pressure to keep their dividend. And many of those companies, for most of 2015, were actually borrowing money to pay the dividend. And as most of you probably know, that is not a sustainable thing. And thus, what they've had to do is cut capital expenditures, and in many cases, very, very dramatically. We think this activity from the major oil companies is going to have very large knock-on effects 2 and 3 and 4 and 5 and 10 years from now, because the big projects they would otherwise be working on are not just getting to FID or final investment decision, they're just being shelved, and that's ultimately going to create a big hole in the world's production, and whether that's 2 years from now or 10 years from now is debatable. That's what's happened with the major oil companies. The U.S. companies, sort of the independents we call them, a bit of a different kettle of fish. And the reason they're a different kettle of fish is that their shareholders don't buy them for a dividend, their shareholders buy them for growth. And so they tend to be highly incentivized to show very high levels of year-over-year production growth. Now, some would argue that is to the detriment of return, and it's to the detriment of the balance sheet, but is what the market historically has paid for. The problem with that is that strategy assumes you can regularly go to the markets, whether it's the high yield market or the equity market, to replenish your balance sheet to keep the growth going in a world where, I mentioned the dirty little secret about the shale world, it doesn't generate much free cash flow for a very long period of time. And so a lot of those companies found themselves in a position of dramatically outspending their cash flow. Now, that has meant bankruptcies, it's meant workouts, and we're in the middle of a lot of that still today. However, for those companies, given what's happened to cost structure, the world is very different at $45 than it was at $40 a year or two ago. So a lot of them can now justify spending capital and spending money at today's oil price.
Yeah, I'd just like to make a comment on sort of that financial structure, something that surprised me, because with these shale plays, the tight oil and shale gas plays, the production is very much front-loaded. I mean, you get a very large percentage of what you're ever going to get in the first 2 or maybe at the most 3 years, and yet it seems like a lot of these are sort of expected to pay off in the long term. In a conventional play where your production is declining by 6% a year, there is a long term, but where you're losing 30, 40, 50% per year in the first few years of production, long term is, what does long term really mean? It means something dribbling out after 30 years.
Right. Agreed.
If I can follow up on this.
Could you identify yourself?
From Citi, sorry, Ed. If I can follow up on this discussion, how much of this do you associate with the fact that we're low interest rates to negative interest rates globally? When does the sector return to, well, no pun intended, but return to requiring a return rate on these investments, or just the required rate of return goes up above, so you actually have some free cash flow? And then if I can ask for Dr. Kleinberg after, on the other areas of the world, oil sands or deep water, what technology can be developed that could bring these costs more in line with what we've seen in U.S. shale, and what's the time scale that you would look for some of these technologies to come to market? Thank you.
So on the first question, we think in the Permian Basin, for example, that in order for companies to live within their cash flow and, i.e., not have to borrow or issue equity to spend capital, but they live within their cash flow, spend only the cash that you are generating, and to keep production flat, we think you need 1,200 rigs and a $52 WTI price. Right? That's a lot of rigs from where we are today, and it's obviously a higher oil price from where we are today. Now, that ties back into why we think the market has to rebalance, because as long as worldwide demand is growing, it has to be met from somewhere, And outside of the U.S. and outside and Saudi Arabia, we actually don't see where that growth can be met. There's no doubt that very low interest rates have dramatically impacted the capital markets' appetite for funding these companies through from this 2012 to kind of 2015 period when there was just this explosion of debt. And the rates at which these companies were able to borrow, these are non-investment grade companies, often single B rated, sometimes not rated at all. The fact that these companies could borrow 10-year money, 20-year money at 6%, for example, is just completely unprecedented. And the reason they could is that investors were very hungry for yield. And your muni bond portfolio and your U.S. Treasuries and your AAA corporates were yielding you 1% and 2%. So the idea that you could get 6% from Diamondback exploration in Midland, Texas, seemed like a pretty good idea until it wasn't. And that is the nature of debt markets. So our expectation is that it will be a while before the debt markets are back open again in the way that they were in sort of the go-go days of 11, 12, and 13. That being said, the equity markets have already reopened. And if we talk to equity investors today, are they really focused on return on capital, or are they focused on growth again? And the short answer is they're focused on growth again. It's just like heroin to public market investors. They can't help themselves because typically if you buy companies who are growing their production and top line at 15 and 20 and 25%, then stocks are going up. They just do. And that's what people want.
Yes. This mic coming. Wait, there was another question. So let's get the question.
Right.
in.
So now I'll take care of the second question, part two, which is what sort of technology are we going to see in rest of world? First, I'd just like to expand that a little bit by commenting on what kind of new production technology we need in U.S. shale, and that is something that doesn't leave 90 to 95% of the oil in the ground. So from our standpoint, that is the main challenge that we face. Right now, we've got a recovery factor of 5, at most 10% in tight oil plays. If we can't improve that, we are leaving 90 or 95% of our resource in the ground, and that is really not acceptable. So that's as far as U.S. is concerned. As far as rest of world, you mentioned deep water and oil sands. Deep water, a lot of the sort of emphasis now in technology development is safety oriented. Nobody wants to bet their company drilling the next deep water well, a la Macondo. So certainly Cameron is working on ever better blowout preventers and all the rest of that stuff. Blind shear rams that actually always work, and so on. So there's a lot of emphasis there, not so much on production technology as on safety technology. Not to say that there isn't production technology going on, but that's really the emphasis. As far as oil sands are concerned, what we're seeing is a lot of people trying out alternatives to steam. You need to heat these reservoirs to get the oil to flow because they're so viscous. In Canada, you could have a million centipoise oil, which is like road tar. From what I've seen there's a lot of these really cool ideas like electrical heating and electromagnetic heating and microwave heating and whatever, and it is very, very difficult to do better than steam. So I don't see any radical improvements in oil sand technology, honestly, although who knows, something may come along and hit us in the head. But for right now, steam is king.
Could you identify yourself?
John Hoey, I'm a co-founder of Titus Oil. We produce 40,000 barrels in Oman, and I was former CEO of Atlantic Refining. I have two statistics to get your reaction. When you talk about cost reduction, no one talks about the cost of the acreage for mining rights. As you all know, Pioneer is $60,000 an acre, and that whole area, the Permian Basin, hasn't come down 5%, and you still have the same 3-year work commitment. I'd like to know your thoughts as to why that hasn't changed. And my second question is, I personally feel we've been too optimistic. Ed likes to talk about prices going up. No one has mentioned prices staying flat or even declining. But there has been some very significant structural changes in consumption. And all you have to look at, when I had the refinery in 85, 85% of the barrel went for transportation. It doesn't go there anymore. So you have real structural changes in supply and demand, and I think they're going to drive the prices. They're going to keep them flat. So your comments, whoever wants to answer.
Well, I'll speak to the second one first, which is I recently heard an interview with Rex Tillerson, the CEO of ExxonMobil, and someone asked him what oil price is going to do. And he said, look, I've got 60 PhDs at ExxonMobil working on that, and 30 of them think it's going to 100, and 30 of them think it's going to 20. So, there are just so many exogenous factors in
And
the oil
actually, if
market.
you look at bets being placed in the market, it's about a 50-50
Yeah,
proposition.
right. Our motto at TPH is if we're wrong long enough, eventually we'll be right. It's just kind of the nature. It's kind of the nature of the oil business. With regard to the Permian Basin and acreage costs, what's the reason acreage costs are so high there is you're not buying one producing horizon or two, you're buying 10. And the question is, how many do you have to pay for? And as technology has improved, and these new benches have been proven, buyers have decided, well, yeah, I paid $40,000 an acre before, but I was buying 2 benches, and now I'm buying 4 benches, and so I'll pay $60,000. And it's actually a good deal. So look, time will tell as to whether they are paying too much for their acreage, but that's what's magical about the Permian Basin is these very, very large sections of stacked pay that give people multiple opportunities. With regard to kind of your structural issue, we would agree generally that there clearly are structural changes going on in the market, but the core, because oil is a global commodity, the question is, what is happening to global demand? We've had global demand go down 1 year in the last 30, and the question is, of course, what happens in the next 30. And our expectation, based on what's going on in the developing world, is we will continue to have worldwide demand growth on the order of 1% a year. That's with demand growth shrinking in the U.S. and probably shrinking in the OECD, but still decades away, at least 2 decades away from shrinking in the developing world. So we're kind of hanging our hat on the fact that, in China, once you get off the bicycle, you don't want to get back on the bicycle. Fossil fuel-driven transportation will continue to grow and grow dramatically in the developing world. And so, but there's a big debate around that. A lot of the debate has to do with battery technology and how quickly battery technology is changing, and might we move to storage-based vehicles a lot quicker than 2030 or 2035 or you name it. But clearly, we would agree there are big questions around consumption patterns for transportation fuel, and a lot of that is tied to new technologies.
Hi, David Friedlander, formerly with Freepoint Commodities, currently a private investor. Firstly, thank you, Robert and Bobby, for your speeches. I've got a question regarding, I guess it's kind of two-pronged, but it's regarding oil field services in Venezuela for PDVSA. I've heard kind of conflicting reports over the past year and a half or so that they were increasing their oil field services commitments with Schlumberger and Halliburton, but and then also like defaulting on some of their service expenses accounts payable. So I was just kind of wanted to get your opinion on where the oil field services companies stand with PDVSA, and also where their countries like Venezuela or Ecuador, where their production is going in that sense?
Ecuador and Venezuela, and I'm sorry, what were the last two countries? Venezuela, okay. Well, yeah, so Venezuela is a pretty sad story. We had sent our top negotiator down there. They owed us a lot of money for services which had been performed but not paid for. We attempted to recover at least a fraction of that in order to maintain our business there. Venezuela does produce, something like 2 million a day. But that has turned out to be unsuccessful, and just recently, and I think this is in the last few weeks perhaps, basically we have said that we're not going to do any more work unless we're paid, and so we are downsizing our operation in Venezuela. And again, I'm not here as a Schlumberger spokesman, so I do urge you to go to our investor relations group for more details, but we're cutting back our activity in Venezuela, at least until they can start paying their bills. It's a very unfortunate situation. We do have some big projects. You mentioned Ecuador. We do have some big projects in Ecuador. We do production management there, so it's sort of big turnkey type projects. On a technical basis, they seem to be going well. I can't really talk about the commercial aspects of it. Did that sort of cover the range of your question?
And I really don't have anything to add to that. I read what you read about Schlumberger and Venezuela. We do. Venezuela is obviously a market with kind of massive resource, but a very poor record of getting it to market, and that problem appears to be getting worse, rather than better.
There's going to be a big discussion of that at Columbia in the next day, I think, or two. When?
On
Wednesday.
Wednesday?
And it has 4 people speaking, does it?
Yes, 5 with the mark.
So maybe you want to come back and visit that.
I mean, the flip side, just for what it's worth, is Argentina is back in business, right? After having been a basket case here for some meaningful period of time. And we see real capital moving back into Argentina. They are in the shale business in a big way. A lot of people would argue that the Vaca Muerta shale there is probably as good a rock as there exists really sort of anywhere in the world as regards unconventional resource, and a fantastic opportunity.
Kevin McGill from New Texas. I just had a quick question on global refinery growth, I guess in the Middle East specifically, and you see some of the news stories about East Coast refiners, and they're coming under pressure significantly in the States, and just the overall quality of the barrel. The overall quality of the barrel between the two marginal producers that you mentioned, between the U.S. and the Saudis, and where that consumption is actually going to be taken. Anything on that?
Yeah, I'm not an expert on the refining business, but I would tell you that it's very clear that the U.S. refining system has historically been more configured for imports than for exports. And so a lot of capital needs to go into the system in the U.S. to reset. And I think that is contributing in a pretty meaningful way to the issue that you're raising. We think that that's a fixable thing, actually. And that yield with capital and with new technology and the right configuration, yields will start to go back up and be more consistent with what they've been historically.
Hi, Tony Yun, Citigroup. Great to see you again. So 2 quick questions. One is, what would make enhanced oil recovery work in shale? We have recently seen an example of, that enhanced oil recovery working, and so to what extent can we raise the recovery rate from 5% or between 3 to 8% to like 10, 15, or even 20%? That's number one. And second is, how big an impact would infill drilling do to Saudi production? Have they done that, and how much can they do? Thank you.
And as you each respond to that question, if you could share with us what you believe the ultimate peak of production in the U.S. might be, under various scenarios of recoverability.
Okay, I'll answer Tony's question, but not yours. Okay, with respect to enhanced oil recovery and shale, as I said, this is the big problem in our industry, certainly from a technological standpoint. And as I said earlier, we're recovering somewhere between 5 and 10%, as compared to our conventional reservoirs where we're recovering 40 or 50% these days. So I think the way forward here is with repressurization of the reservoir, and with a couple more slides I could show you exactly how tight oil is produced, but basically it's produced by what's called solution gas drive, which is you've got a lot of dissolved gas, and that's really when you reduce the pressure by drilling a well and then relieving the pressure in the well, that gas exsolves. It's like opening a bottle of champagne and the champagne kind of whooshes out. Now, you also know that you don't get a lot of champagne out of the bottle based on that release of carbon dioxide. And that's why we're only getting 5%. We're getting a huge amount of natural gas liquids and methane out of these tight oil wells, and that's great for the petrochemical industry. But most of the oil gets left behind, and now it's dead oil. It doesn't have the dissolved gas that we need to drive production. So the solution might be to repressurize with gas and get the thing started again. Now, EOG has actually announced some success with this in South Texas using field gas that they have on site and repressurizing. They have disclosed no details. They've just said that they've done it and that they're going to continue to do it. So that's very tantalizing for technologists like myself, but we're sort of waiting for them to publish the details of exactly what they've done. Now, that said, as I said, they're using field gas. It would be much more effective to use carbon dioxide. Carbon dioxide dissolves in oil much more effectively. You'll get much more oil out. Unfortunately, the oil industry lives in a carbon dioxide constrained world. Seems kind of ironic, but we don't have enough carbon dioxide to do all that we would like to do in terms of enhancing production. So I think that's the way forward. I would be watching those EOG press releases. Now, the second part of the question was infill drilling. And what exactly was the question? In Saudi Arabia. Ah, right. So, Simmons had this book, Twilight in the Desert, some years ago, predicting that Saudi Arabia was about to run out of oil. I don't think so. When you look at the number of rigs and the number of wells that have been drilled in Saudi Arabia compared to the United States, it's really very few. They clearly have a lot more potential to drill another well between two existing wells. So I think Saudi Arabia, they've announced they can produce 12 million a day. I have no reason to think they can't with a more determined drilling program. So Saudi Arabia is going to be a big player for the rest of our lives, no doubt.
You had a question?
Xiao Jing, Bachelor in Petroleum Engineering, now a Master in Civil Engineering. So I just got two quick questions. The first is about, so most of the innovations you talked in this presentation is more about in the field, like drilling or completions. But how about the reservoir engineering? How about the simulation done for the reservoirs? So will this contribute a lot in the industries? And the second question is about the natural gas. So how about what do you think the natural gas, the price of natural gas? Because right now it's kind of cheap, but I read some report from the BP. They said the demand of natural gas in 20 years will kind of increase dramatically. So what do you think about the price of natural gas?
Okay. Well, I'm going to warn my fellow panelists that they're going to have to answer the natural gas question. But yes, you ask a very, very good question about what about reservoir engineering and reservoir simulation of shale. These are very fundamental questions that we are working on, in fact, at Schlumberger. And it's very, very exciting from a technology standpoint because, you know, we've been producing from conventional reservoirs for 150 years. These are the sandstones, the carbonates. We understand them pretty well. We've worked out all the petrophysics and so on, and the reservoir models are pretty good. Not, you know, not ideal, obviously, but actually pretty good. But now with the shale is a totally different kind of rock. The pore sizes are 1,000 times smaller, so it's not just laminar flow anymore. There's very strong interactions between the hydrocarbons and the rock surfaces that we're trying to understand, especially because these are organic-rich rocks, which means that you have oil and gas sticking to organic matter, which naturally likes to absorb it. So, plus you have fracture systems on many length scales, not just the fracture you make, but the microfractures within the rock. So there's a lot of fascinating things going on. There's been a lot of literature in Society of Petroleum Engineers papers, but this is something where we're going to see steady progress for a long time, and we are far from done with that question. Yes.
Well, with regard to natural gas, just real quickly, we do see increasing demand for natural gas, not just in the U.S., but globally, in China in particular. But natural gas remains a regional market effectively, notwithstanding that we increasingly will be able to export natural gas via NGL export from this country. The problem for the natural gas industry in the U.S. is there's just too much of it around. You know, the success in extracting natural gas from unconventional reservoirs, whether it's in the Marcellus or the Utica or the Barnett Shale or the Haynesville or the Eagle Ford, or you name it, the success associated with that has just completely overwhelmed almost any outlook for demand growth. And thus, we think there's a bit of a cap on natural gas prices at about $3.50 in MMBTU. We're currently just below $3 today. It also is still related to coal prices because there is a lot of switching that happens in the U.S. power generation world when natural gas prices get too high. If coal's a lot cheaper, a lot of people will start to burn coal. That over time will go away because we're not commissioning any new coal plants in the United States, and we don't expect to. But there remains an important relationship there. Right now, the Haynesville Shale, which is in East Texas and Northwest Louisiana, is basically completely turned off. There's very little drilling that's happening in the Haynesville. And if we just flip that switch on, there would be a flood of new gas coming into the U.S. market. So our view is that it's hard to imagine natural gas prices going up really dramatically for quite a long period of time.
There was a question over there.
Thanks. Jan Lager from Franklin Templeton. You mentioned two countries where you kind of putting your hope on producing the incremental barrels we'll need over the next, let's say, 3 to 4 years, U.S. and Saudi Arabia. I guess we can add Russia to that as being sort of top 3 countries in the world, 10 million barrels each right now, plus or minus. I'm just trying to I guess, push you a bit on whether or not those 3 countries can sustain production or grow production, given even in the U.S. the productions got stuck, kind of flatlined before falling. Can production actually start rising fast enough to meet that demand in the U.S.? Same question in Saudi Arabia. I mean, capacity 12 million, but has never really reached over 10 ever. And this is the best time for them to go to 12 million right now, but yet they haven't. Same thing in Russia. I mean, are we really able to produce in those 3 countries to sustain that?
Well, it's a good question and a fair question, and a lot of the oil bulls kind of hang their hats on that and say that it actually is very hard to grow production, even in Saudi Arabia and in Russia. You know, in the U.S., though, remember, we went from 5 million barrels a day onshore to 10, right, in about 3 years, 4 years. I mean, a very, very dramatic
Well,
growth.
even more dramatic if you add to it things that look and smell like oil, that are liquid.
Yeah.
And the number was 14.7 or 14.8.
Right. So we've shown in the U.S. we can do it. The resource the resources there. Look, I know less about Saudi resource. My impression is that it's highly tied to capital, and that if they really wanted to increase capacity, they could, but it would just take an awful lot of money to do it. Russia, I just know I know less about. I have to say, I don't know, Ed, if you follow that market more closely, but.
Sure. I mean, on Russia, I think it's capital constrained too, and had financial sanctions not been imposed, production would have grown by more than the 1% per year it's been growing since those sanctions were imposed.
Yeah, I just want to comment sort of the geological part of the answer. With respect, and let's just look at shale just to specialize. Saudi Arabia has been looking for shale resources and has not done too well. They've drilled in the Kasaiba. It doesn't look too promising. So I think there's probably not much shale play in Saudi Arabia, or at least it hasn't been discovered. Russia's a very different story. I and other people think that Russia has enormous shale resources in Bazhanov and Dominik. And of course, those resources were the subject of joint ventures with Western oil companies before the imposition of sanctions. Now, as soon as the sanctions were imposed and Shell and Exxon sort of beat a retreat, those projects died instantly. But they didn't die for lack of resource. They died for lack of interest on the part of the Russians, who have plenty of conventional resource to focus on. They didn't really need the shale like Exxon did to improve its resource base. So I think there's probably a future play in Russia if and when those sanctions ever come off, and subject to, as we've said, to capital constraints and so on, but there's a lot of resource there.
One final question. Just wait 1 second.
My name is Sam Glasser, and you've been talking about production of getting the oil out of the ground, but what about getting it to market? Because we're seeing the dust up in North Dakota now with the pipeline that's going to bring the oil sands crude down into the U.S. and the problems with trying to get expanded pipeline capacity out of the Marcellus into New England. In fact, I saw a commentary the other day that said a lot of the environmental groups have kind of given up on the idea that they can shut down oil sands production, but if they can put a roadblock on the pipelines, it's going to bottle it up.
Right.
So how does this all play out?
Well, the severity of that issue differs dramatically by the region of the country that you're talking about. So infrastructure in Texas and Oklahoma is not an issue. Getting permits is not an issue. Getting the oil to the refinery is not an issue. Hiring people to do it is not an issue. It's interesting. I don't know if you followed the recent debate in Colorado, where an anti-fracking bill was on the sort of in the market, if you will, and they ultimately did not get enough signatures to get it on the ballot there. The industry was quite concerned that if they did that, it was going to dramatically retard growth of the industry in Colorado. But it is very clear that there are places in the country that just have no appetite for allowing the infrastructure to be built and get to market. My view on that, just for what it's worth, is that the industry is highly resourceful, and it seems to have a way of ultimately getting the product it needs to serve the market, and that may mean that industry activity gets more and more concentrated in fewer places. I certainly wouldn't worry about the Houston Ship Channel and West Texas being put off limits for infrastructure. So, are there issues around that? For sure. I would argue that sort of the boom times, particularly in the Williston, the industry did not do a great job of policing itself, and there was mess in and around it. I think it's now more sensitive to that as it needs to be, and hopefully will be better when prices improve and more drilling happens there.
Yeah, I'd just like to add a comment about the Keystone Pipeline. I looked at the economics of that. And when Brent was below 30 back in January, the price of Western Canadian Select at Hardisty was 14 or 15. And that's below the lifting cost of oil sands in Alberta. Now, if the Keystone Pipeline had been in existence, it would have potentially increased the price of Western Canadian Select by about $8. So it would have been 22. So at the trough, Keystone meant the difference between an economic and an uneconomic oil sand industry. Now that the prices have gone back up, you know, okay, they could still ship it by rail and make money. But it was a very interesting moment in time where that pipeline actually did make a difference for a few weeks. I mean, a qualitative difference.
Maybe I could add to that one gratuitous comment. If there is a government that's even less functional when it comes to oil policy than the U.S. government, it may be the Canadian government.
Canada, yeah.
And clearly the rational place for that oil to go is west and not south.
Right. Yeah.
Anyway, thank you both very, very much. And those of you who want to have access to the underlying slides, they will be posted at least on the New York Energy Forum website. It may also be on the Columbia website. I can't speak for that. And there are refreshments right across the hall going forward, so there'll be time to network. Thanks a lot.
Thank you.
That's great.
Very nice. Yeah.